It's February 27th, JLD here, and welcome to MSTR Today and the Treasury Titans. Nothing in this video is financial advice, but Michael Saylor standing there, and he knows he's going to need a bigger bag. He's actually going to need a bigger orange bag specifically. So there's Michael Saylor looking down the hallway saying, I'm buying more Bitcoin. I am buying a lot more Bitcoin. Are you with me? And then I love Fong Lee's post. AI has been positioned as a self-reinforcing doom loop. The more AI is successful, the more it is a threat to the core pillars of humanity: relationships and people, democracy and choice, industry and work. Bitcoin is a self-curing do loop. The more Bitcoin is successful, the more it strengthens these same foundations of humanity. I believe this as an optimist technologist leader and as someone who is living the human dream. For 10,000 years, the rise of civilization has had a symbolic relationship with analog money and capital. The AI era will have a similar codependency with digital money and capital. Bitcoin's do loop will prevail over AI's doom loop. Oof. And I love Joe's comment of 100. Moving on to Stretch.live. This is a great site to follow, a great handle to follow, I should say. STRC at 99.99 on 753,000 shares. Second straight day above threshold. 84 Bitcoin estimated today, building on yesterday's 35. ATM humming again after that 8-session drought. Yield at 11.25%, 1 penny from par. And then I will say it closed at par at 100. So we'll see where it opens because Bitcoin's down a little bit right now. It's in the 66 era region, I should say, area. So we'll see what Stretch opens up at, but we still have a couple weeks before the ex-dividend snapshot. So let's go Stretch. Max Kaiser had a great post. He said, strategy is the opposite of Jane Street. Relentlessly accumulates Bitcoin, never sells. Completely transparent. Ethically mission-driven versus predatory delinquent, which of course is Jane Street, a predatory delinquent. So Max Kaiser jumping on, not that he's never not been on board with Michael Saylor, but I loved that post and I wanted to share it. And this was another great post from Matt. He said the conspiracy theories are wild. First it was Binance, and then it was Wintermute, and then it was an unknown offshore macro hedge fund, and then it was paper Bitcoin, and today is Jane Street, and next week it'll be someone else. The real reason Bitcoin is down is that a bunch of people who are long Bitcoin sold their Bitcoin exposure. They sold it via spot, they sold it by unwinding leveraged positions, and they sold it by writing calls against their Bitcoin. They sold because of the 4-year cycle and because of quantum fears and because they wanted to invest in AI startups and for other reasons. They are mostly done selling, and we are in the process of bottoming. We will set new all-time highs in the future. This is a classic crypto winter, and there will be a classic crypto spring. People want someone to blame. I get it. But the reality is far more boring than that. And I just thought that was really well said. And with these two lines here, it was probably said by AI, so good for you, Matt. But at the end of the day, these are wise words, and they are very likely to be true. Halston said, Strategy World was unlike anything I've experienced at the Bitcoin event. TD, Citi, Morgan Stanley, Anchorage Digital, banks having real convictions about Bitcoin-backed digital credit and a 300 trillion global credit market. And I noticed everyone kept saying the same thing. This event was refreshing. Like we were actually watching change happen right in front of our eyes. If you're someone screaming suit coiner every time Bitcoin touches an institution, you're not principled, you're performative. Because Bitcoin-backed products are how this reaches everyone, not just the people who found it early. You don't get purity points for trying to protect your own exclusivity. And if that makes us suit coiners, fine. At least we're trying to bring the masses in instead of keeping them out. Thank you, Strategy and Saylor, for a phenomenal week. Well said. James jumped in here and said, the U.S. economy is reaccelerating. The business cycle is starting to expand. Liquidity has bottomed. U.S. Treasury securities on the Fed balance sheet are now back at November 2024 levels, i.e., QE, but not QE. Rotation from extremely concentrated U.S. tech to cyclical stocks is broadening the overall market. Look at stocks globally. Bitcoin has its own unique issues and will eventually participate to the upside. Coinbase Premium plus ETF inflows starting to emerge. Let's go. James, break it down for us. And then the Angry Buddha had a great article. I'm not going to go through it because it's a fairly detailed and long article, but I would recommend if you want to check it out, just search for Angry Buddha on X. It's called The Reflexive Bitcoin Digital Flywheel, Alpha from Strategy World 2026. Definitely a great article about his time there, and he's blown away by the Bitcoin credits flywheel taking shape. Oh my God. I've been blown away for 2 years. So welcome to the game, Angry Buddha. It is just a great place to be. And so many people are so bewildered and so late, and we are so early. And let's keep rolling as soon as we get back from thanking our sponsors. Scams and identity theft do not start with hackers. They start with your personal data being easy to find online. Your home address, phone number, and employment history can be sitting on dozens of websites right now, waiting to be used for fake loans, targeted scams, or worse. That information is spread across people's search pages, shady directories, and commercial databases you've never even heard of. That's where Incogni comes in. Instead of spending hundreds of hours manually opting out of these sites, Incogni automates the entire process. They hunt down your data and demand its removal. Incogni doesn't just do this once. They continuously monitor these sites in the background to make sure your data doesn't reappear. I recommend the unlimited plan because when something isn't covered automatically, Incogni's custom removals feature lets you send in a specific link and a dedicated privacy expert takes care of the manual removal for you, start to finish. Remember, if they can't find you, they can't use your data against you. Take your data back risk-free with Incogni's 30-day money-back guarantee. Use code MSTR for 60% off an annual plan at incogni.com/MSTR. That's INCOGNI.com/MSTR. When you want more, start your business with Northwest Registered Agent and get access to thousands of free guides, tools, and legal forms to help you launch and protect your business all in one place. Build your complete business identity with Northwest today. Northwest Registered Agent has been helping small business owners and entrepreneurs launch and grow businesses for nearly 30 years. They are the largest registered agent and LLC service in the U.S. with over 1,500 corporate guides, real people who know your local laws and can help you in your business every step of the way. Build your business identity fast with resources, forms, and step-by-step guides even before creating an account. Sign up to manage your business hub with lawyer-drafted documents. Northwest is your one-stop resource, makes life easy, and keeps privacy automatic, never selling data anywhere. Don't wait. Protect your privacy, build your brand, and get your complete business identity in just 10 clicks and 10 minutes. Visit www.northwestregisteredagent.com/JLD free and start building something amazing. Get more with Northwest Registered Agent at www.northwestregisteredagent.com/JLD free.
The junior pref doesn't have the covenants, so you've got more optionality, fewer covenants, longer capital. The convertible prefs have a lower cost, fewer covenants, longer capital. And then when you get to a variable preferred, what's going on is the optionality is exploding. You're getting more optionality. You don't have the option to vary the coupon of a bond, but you do have the option to vary a monthly dividend. So as the optionality explodes, the duration lengthens. And so and of course, the last form of capital is equity. I sell $10 million of equity, I have the money forever. Well, from a net present value point of view, that means I've got economic benefit for about the next 100 years before the benefit becomes third order. So if you look at the table, you can see if you want to invest for a long period of time, you'd really like to use equity. But if you can't get the equity, what's the next best thing? Well, it's variable preferred credit. We discovered digital credit and stretch because we kept moving out this curve of risk. And we found what we thought was the longest duration capital other than equity. Now, what is digital credit? It's solving the investor dilemma. The dilemma of the investor is I either get double-digit returns and I get deferred tax treatment on equity, and I take large volatility, large drawdowns, and I might lose my capital. Or I buy credit where I have principal protection, low volatility, but I lose the double-digit returns, and I have to pay ordinary income tax, or I have to pay capital gains tax every time I receive anything in that year. So what if you wanted the benefits of equity and the benefits of credit, and you wanted to get rid of all the liabilities of both? What we did with STRC was created this instrument which gives double-digit returns, deferred capital gains tax treatment, low volatility, principal protection, all at the same time, right? And that's the big unlock there, right? You don't have to make a compromise. And who's it designed for? Well, it's definitely designed for retail investors. It's also designed for corporations, but you can also offer it to an institutional investor, a hybrid investor, or a crypto native investor. So there's lots of different classes of investors that might want this. Um, in the process of building the longest duration credit, we inadvertently discovered that all of the dividends for that credit are return of capital dividends. There are three types of ways to tax credit. You either tax it as ordinary income and you got to pay income tax up front, or it's taxed as capital gains, or it's taxed as a deferred return of capital. You don't have a tax on it. Well, in order to create return of capital, you have to have a treasury company that doesn't have positive earnings and profit that would create a tax liability that you'd have to pass on to your credit investors. So what we discovered was we could create credit where the tax benefits go directly to the credit investors instead of accruing to the issuer. And because as an issuer, we don't actually generate taxable cash flows, we don't need the tax benefit. Most credit created by companies was always to the benefit of the issuer, to the detriment of the investor. And we stumbled upon a new idea. What if we created credit which was the benefit of the investor, the best credit? The credit becomes the product, not the means to the product, right? Well, so you create this, and now the issue is, how do I assess the digital credit? What's the mathematical framework for assessing credit risk? And really, we created three metrics. BTC rating is the amount of collateral coverage. Like if you're BTC rated 5, it means you got $5 of equity for every dollar of credit outstanding. BTC risk is the probability that you get under collateralized at the end of the term. If you have $5 today, will you have only $1 of collateral at the end of the term of the credit, to pay it back if you had to pay it back? And then if you calculate that BTC risk, you can back into a credit spread. What is the fair credit spread above the risk-free rate that you have to pay the investor to offset the risk, right? So there are simple formulas here for people that like formulas, but maybe the bigger point is the credit spread of investment-grade bonds today is 78 basis points. That means you're getting paid 0.75% more than the risk-free rate in order to take the credit risk of a company like Apple or Microsoft. The credit spread of junk bonds, or high yield, I guess, is 288 basis points. So those are the two benchmarks worth looking at. And now we move to the theory of asset-backed credit. What is it? Well, the idea is I buy a capital asset that's going to return 30%, and I strip off the first 11%, and I pay it to the credit investors. Maybe I buy the S&P index, I expect to pay 12%, I strip off the first 6, and I pay it to the credit investors. If gold is going to appreciate 10% a year, I could create a preferred instrument that pays 5% a year and pay that to the credit investor. So, and logic says you're not going to pay a dividend greater than the return of the capital asset over 100 years. That you're going to eventually run out of collateral. But you can certainly pay a dividend rate lower than the ARR of the capital asset. And that takes us to the question of what's really going on here. What's the second best? There is no second best.